What if the market crash everyone's terrified of in 2026 is actually the best thing that could ever happen to you? Sounds insane, right? But every major wealth boom in history started during a time of panic, when most people were running away from the market. Think about it. In every crash, fortunes don't disappear, they just change hands. And the people who understand why the system resets are the ones who end up on the winning side. Right now, experts and insiders are whispering about one thing: a potential 2026 downturn that could rival the dot-com collapse or even 2008. AI stocks are overheated, interest rates are biting, and debt levels are at record highs. The warning signs are everywhere, but so is the opportunity. Because if history repeats itself, and it almost always does, this crash won't just wipe people out. It'll quietly make a new wave of millionaires. And in this video, we're breaking down exactly how the 2026 market crash could make you wealthy, if you know what to do before it hits. Every crash starts with the same story: overconfidence. And right now, that story is playing out again. Stock valuations are soaring far beyond what earnings justify. The S&P 500 is trading at levels we've only seen before major corrections. Tech stocks, especially those tied to AI, have become the new can't-lose bet. And that's exactly what people said about dot-com companies in 1999. Even central bankers are nervous. Jerome Powell recently hinted that markets might be pricing in too much perfection, which is just a polite way of saying investors are ignoring reality. And when interest rates stay high while corporate debt keeps growing, it's like stacking dominoes. One wrong move, and everything can fall fast. Some analysts even believe 2026 lines up perfectly with the 18-year economic cycle, the same pattern that predicted crashes in 1989 and 2008. If that holds true, we're sitting right on schedule for the next big reset. But here's the twist. These same warning signs that scare most people are actually the signals smart investors wait for. Because when fear hits its peak, that's when assets become cheap. And if you know how to spot that turning point, the chaos that wipes others out could be the moment you start building real wealth. If you've been watching the markets, it feels like everyone's holding their breath, waiting for something to snap. And there's a reason for that. The setup looks eerily familiar. First, interest rates. After years of cheap money, the global economy is struggling to adjust to the higher costs of borrowing. When businesses can't roll over their debts and consumers tighten their wallets, earnings shrink fast. That pressure builds quietly until it explodes. Then there's the AI bubble. Just like crypto in 2021 or housing in 2008, investors have poured billions into anything labeled AI, pushing valuations to extremes. Everyone's betting on infinite growth. But that's not how markets work. Once reality hits and profits don't match the hype, those sky-high prices can collapse overnight. Add to that the mountain of global debt, trade tensions, and a potential wave of layoffs as companies cut costs to survive. And you've got a perfect recipe for panic. The headlines will scream disaster. People will rush to sell. But here's where things flip. Hidden inside that panic is pure opportunity. When fear takes over, even strong companies get dumped for cheap. Real estate, energy, and certain blue-chip tech firms could drop far below their real value, offering the kind of entry points you only see once every decade. Smart investors don't run from crashes. They prepare for them. They build cash reserves, make watch lists, and wait patiently for that emotional overreaction. Because when everyone else is saying it's over, that's usually when the next generation of wealthy investors quietly step in. The people who come out of a crash wealthier than before all have one thing in common. They prepare while everyone else is distracted. They're not glued to headlines or guessing the exact crash date. They're quietly positioning themselves right now. The smartest investors are building cash reserves, cutting unnecessary debt, and tightening their portfolios so they can move fast when the market starts bleeding red. Before the crash, they focus on quality, strong companies with real earnings, not hype. They diversify just enough to stay flexible, but keep a list of targets ready. Solid businesses, undervalued sectors, even real estate opportunities that become affordable once panic sets in. Then, when the sell-off begins and everyone else is panicking, they stay calm. Instead of asking, "How much am I losing?" they're thinking, "How much cheaper can I buy?" That mindset shift is everything. During a crash, emotions are the biggest enemy. The rich don't panic sell, they accumulate. They understand that wealth transfers during times of fear. It's not about timing the bottom perfectly, it's about having the courage and liquidity to act while everyone else hesitates. Because when prices drop 30, 40, even 50%, that's when generational wealth quietly changes hands. And the investors who plan for that moment don't just survive it, they thrive from it. But what happens after the crash, when the dust settles and the markets start to recover, is where the real fortune begins to grow. Here's the part most people never talk about: the aftermath. Because once the panic fades and the charts stop bleeding, the world quietly enters the wealth-building phase. Every crash is followed by a recovery, and history shows that those rebounds often deliver the largest gains in the shortest time. The investors who bought during the chaos aren't sitting there hoping anymore. They're watching their portfolios multiply while the rest of the world is still scared to re-enter. Take a look at past cycles. The people who invested in 2009, when everyone else swore the market was finished, saw returns that changed their entire financial trajectory. The same thing happened after the dot-com bust. It always does. Panic creates the setup. Patience creates the profit. This is when compounding becomes your secret weapon. You're not chasing short-term flips. You're letting time do the heavy lifting. The assets you picked up for pennies on the dollar start to recover, then outperform. Dividends grow, rents rise, innovation returns, and your wealth expands quietly in the background. And while the headlines start celebrating the comeback, you already positioned yourself months, maybe years, ahead. That's how real wealth is built after a crash. Not through luck, but through preparation, timing, and the courage to act when it felt impossible. But there's one more piece to this puzzle: protecting what you've built. Because opportunity doesn't mean safety, and the next phase requires just as much discipline as the crash itself. Let's be real. Opportunity means nothing if you can't protect what you've built. And the truth is, not everyone who invests during a crash comes out wealthy. Some jump in too early, some panic sell too late, and others gamble instead of strategizing. The first rule? Don't over-leverage. Debt amplifies everything: profits and losses. When markets drop, margin calls can wipe out years of effort in days. Smart investors keep their positions manageable so they can sleep at night, not sweat every headline. Next, diversification isn't just a buzzword, it's survival. Even if you believe in one sector, like tech or real estate, you never know which domino will fall first. Spread your bets. Part in cash, part in equities, maybe some in alternative assets like gold or index funds. That flexibility gives you staying power when volatility spikes. And most importantly, emotional discipline. The biggest wealth killer isn't the market, it's human behavior. When prices fall, panic feels logical, but the wealthy know that emotion is the enemy of return. They follow data, not fear. Remember, getting wealthy from a crash isn't about calling the exact bottom. It's about surviving long enough to benefit from the rebound. Protect your downside, stay patient, and you'll still be standing when the next wave of opportunity arrives. Because in the end, the 2026 market crash won't reward the loudest voices or the boldest predictions. It'll reward the ones who prepared quietly, stayed calm, and played the long game. But that leads to one final question. If this cycle really does repeat, and 2026 becomes the reset everyone fears, how will you position yourself before it happens? Every generation faces one defining financial moment, a crash that either destroys their savings or builds their legacy. The 2026 market crash, if it unfolds the way experts predict, will be that moment for millions of people. Most will panic, pull out, and swear off investing forever. But a small group, the patient, the prepared, The ones who see patterns instead of fear, they'll view it differently. They'll understand that wealth doesn't vanish in a crash. It simply changes hands. They'll remember that behind every panic headline is a chance to buy the future at a discount. And years from now, when the market hits new highs again, they'll look back and realize, that was the moment everything changed. The truth is, you don't need to be a financial genius to turn a crash into an opportunity. You just need a plan, a calm mindset, and the courage to act when it feels hardest. Because that's exactly when the doors to real wealth quietly open. So the question isn't whether the 2026 market crash will happen, it's whether you'll be ready when it does.